these check marks of checking them, that if we do have somebody else where it happens, we'll catch it. Just like I caught this.
Oh yeah.
Hi Brian, time to do a updated video cast?
It's time.
Okay, let's get after it. Thank you for joining us. Today is October 20th, 2015. My name is Joe Terril, president of Terril and Company. We're independent wealth managers headquartered in St. Louis, Missouri, with approximately $735 million in discretionary assets under advisement. We will talk about a brief update to the economy and our outlook for investment markets. And as always, helping me today is Brian Curtis. And Brian, if you're ready, let's start chatting a little bit about the world economy. Markets have calmed down a little bit over the worries and concerns that the Chinese economy was somehow going to go into a recession, and therefore, like dominoes, every other economy in the world would slow down and we would have a worldwide economic recession. It's also a little bit of belief that people have that, well, gosh, commodity prices are coming down, whether it's oil, copper, steel, chemicals, prices of raw materials, metals are all down in price. Therefore, that must be demand for these products around the world falling off. Therefore, the world economy must be slowing radically. Therefore, gosh, watch out. This thinking that came about in August perpetuated itself into September. We didn't believe it then, we don't believe it now. We've said this now for the past 2 to 3 months, continue to say it. Cheap, abundant energy prices is good for the world. Lower prices of materials that you manufacture into finished products is good for the world economy. Continuing improvements in technology, productivity are good for the world economy. These are not things to be fearful of. I believe you're seeing it halfway through this corporate earnings season that we're into right now, where companies are reporting their results for the third quarter of this year. The doomsayers said the strong US dollar and these other events were really radically going to hurt corporate profits. That's not the case. We have not seen it, and we're halfway into the season. Profits are coming in just fine, and cash flow is good, and we're not seeing this doom and gloom scenario unfold because of a strong dollar and cheap prices. So we continue to believe that the world economy is going to do okay. It's going to grow on average 3.5% perhaps. That's everybody put together, including third world countries who are not doing great right now. China, with a 6.9% GDP figure reported a couple of days ago, is towards the top range. United States at arguably 2%. Europe at nothing. We think will pick up as the next 6 months to 9 months progresses, and the European economy will help also improve the world economy. So we see nothing out there for the moment that leads us to believe that somehow the world economy is getting ready to go into a recession or even a severe recession. Central banks all around the world, including the United States Federal Reserve Bank, are very accommodative right now. If we did have a severe recession, it'd be the first time we've ever had one at a time frame when central bankers are so accommodative with credit. It's normally a bad economy, when central bankers tighten on the credit spigots, drain liquidity out of the system, and capital is hard to get, that tends to slow down economic activity and create more of a recessionary environment. We do not have that at the moment. We have the exact opposite. So these are the main fundamentals of why we're not worried about the world economy. So with that said, Brian, let's switch and maybe just chat about investment markets for a moment. We were very surprised by the investment market sell-off during August and September and how fast market participants all around the world decided doom and gloom was upon us. We not only saw stock prices drop 10 to 15% in many various indexes, we also saw corporate bond prices in many cases fall 5, 6, 7% or more as people began to wonder, could we get into another corporate credit crunch predicated upon maybe the bankruptcy of producers of raw materials, and therefore we'd see a freeze in credit around the world, much like we did in '08. Our answer to that then was no, and it continues to be no. But that didn't keep people from having severe worries and concerns during August, September. '08/09 was a very unique time in the world economy and investment markets caused by very unique circumstances. We continue to have every so often these periods where people worry that the ghost of 2008 is getting ready to jump out from around the corner and create difficulties for them. So we were surprised by what happened in August, September, but we're not necessarily surprised that calmer heads have begun to show themselves, and so far for October, investment markets are showing gradual and continued improvement. We would think this would continue for the balance of 2015 as corporate profits are coming in okay, cash flows are good, the economy is doing well, interest rates continue to be very accommodative, and in general, stock prices are not grossly overvalued. Corporate bonds are in better credit conditions than they've been in a long time. So we continue to be constructively bullish about stock and bond prices between now, October 20th, and the end of the year. Brian, thank you for your help this afternoon. Once again, I'm Joe Terril, president of Terril and Company, independent wealth managers in St. Louis, Missouri. Today's October 20th, 2015, and we'll be back with updated comments as either they're warranted by activities or in 30 to 45 days. In the meantime, for those people who are clients of ours, if you have any questions, please don't hesitate to contact us by any of the various communication methods that we now have in today's world, regular phone, text, email, etc. So we thank you for joining us, and we'll see you probably in 30 to 45 days.